Are you ready to build, grow, and protect your investments? Welcome to the Index Investing Show, where we give you the tips, tools, and philosophy for reaching your financial goals. And now, your host, inventor of the Portfolio Report Card and author, Ron DeLegge.
All right, welcome to another thrilling episode of the Index Investing Show. Coming up on today's program, we've got Sylvia Jablonski with Direction Investments joining us. They just launched a brand new lineup of exchange-traded funds that use relative weighting. So what is that? How does that work? Well, stay tuned for that interview coming up a little bit later. Also on today's program, we're going to give you a quick recap of what's going on globally in financial markets. We'll also take a look at this sector-wise because there's a lot of good things happening for sector investors. Also, I want to cover what I call commandments for trading ETFs. So I'm going to share with you some of the things that you need to know, best practices if you're buying and selling ETFs, what you need to know, what I call the commandments for trading ETFs. If you'd like to join us to talk about a particular stock, mutual fund, or ETF, we're game. I'm game. The phone number 844-305-7800. If you cannot call or get through, you can always tweet us at Index Show is where you find me on Twitter. You can also email the program, ron@indexshow.com. So let's just take a look real quick at market action this past week. The S&P 500 rising a little over 1.5%, led by the energy sector. Can you believe this? Look at crude oil prices, folks. They've been rising, and that has helped the energy sector to continue to surge higher. We'll get you specifics in terms of year-to-date performance a little bit later, but that was the best performing industry sector, moving a little over 3% on the week. So that has been a strong area. We continue to see fourth quarter earnings rolling in and continuing to be pretty good. Most of the earnings being reported by S&P 500 companies are above analyst expectations. Now, there's been a couple of misses. Obviously, you're going to have misses no matter what. The misses seem to be concentrated among some of those chip makers, companies like NVIDIA and Intel, which have struggled. But nevertheless, for the most part, corporate earnings for the fourth quarter have been very, very good. In terms of other industry sectors, consumer staples, there was a big move in Procter & Gamble this past week. The company had its share price move just over 4% as it reported better than expected fiscal earnings. And the company was also upgraded by Berenberg, which is, I guess, a brokerage company. But nevertheless, that was a positive move in the consumer staples industry sector. So that's what's going on there. We'll get on what's happening industry sector-wise and some of the ETFs tracking them. Now, taking a look at our Twitter feed at Index Show, a couple of things I wanted to alert you about. First of all, if you missed last week's program, we did a money battle of Investor A versus Investor B. Who won the battle? Both trying to make as much money as possible, both with similar circumstances, both with a planned savings regimen, but at the same time, both starting at different ages. So who won the battle? Investor A or Investor B? Listen to that archived podcast. You can go to indexshow.com. You can also listen at Spotify or Apple iTunes. I wanted to bring to your attention, this is also on our Twitter feed. I've got a link to that podcast, by the way, at Index Show. But also, we talked about this several weeks ago, companies filing bankruptcy, and we have seen an uptick in that activity of bankruptcy, particularly with companies in the retailing sector. Well, we have one of the biggest bankruptcy filings in years in the utilities sector, PG&E this past week filed documents for the U.S. court seeking Chapter 11 bankruptcy, and the company beleaguered by the California fires of last year. This, as I indicated to you several weeks ago, obviously this has impacted many people's lives. We don't want to overlook that in terms of the people that lost their homes, the people that lost their lives, their belongings, perhaps family members and pets. I mean, that obviously is that comes first. But at the same time, we got to look at this from a financial angle in terms of what impact is this going to have on people's future, people that work at PG&E going forward. And I indicated to you that this, everyone talks about Enron. Enron, at the time of its bankruptcy, had 4,000 employees. And PG&E, by last count, has 20,000 employees. So, 5 times more employees working at PG&E. But the point is that how many of those employees were concentrated or had most of their assets or wealth or a big number of it in PG&E stock. And so this is really something that we continue to warn you about over-concentrating your wealth in company stock, because we don't know at what point in the future that company may encounter problems. And so one of the ways to hedge or diversify against that risk is by spreading your money into maybe areas that are similar to your sector or industry where you're working, if you like that sector. Something that you could do, for example, would be ticker symbol XLU, which is actually tracks the S&P 500 utilities, which is a peer group of PG&E. So XLU, a great substitute for a stock like PG&E, and XLU, by the way, ahead by just over 3%, and it's a diversified approach that will take away that concentrated risk that at any moment individual investors and individual stocks face. You may have a long string of success in a company, and then all of a sudden, bam, something goes wrong. There's a scandal. There's a crisis. There's an unforeseen occurrence that strikes the company, and all of a sudden, years and years of gains are suddenly wiped out. And that certainly is the case with PG&E. It paid a nice yield. It did well for many years, but now here you have a crisis that puts the company into bankruptcy. And so PG&E, if you just look at the peer group, XLU is the ETF that tracks S&P 500 utilities. It holds a diversified group of world-class blue-chip utility stocks. So, for example, inside XLU, you've got 27 different companies, and it's diversified. So some of the top holdings, I'll give you the top 3. Next Era Energy, Duke Energy, and Dominion Energy. So those are the top 3 holdings, along with the other 24 stocks. And so this is a great way to still invest and stay invested, but to do it in a way that reduces your risk to single stocks. 844-305-7800 is the number. You're listening to the Index Investing Show. Coming up on today's program, we're going to talk about commandments for trading ETFs. I'm going to share with you some insights, things that you need to know when you're buying and selling exchange-traded funds. Also coming up a little bit later, we're going to have with us Sylvia Jablonski. She is from Direction Investments. We're going to talk about a brand new lineup of ETFs that use what's called a relative weighting strategy. Well, what does that mean? How does that work? And we'll explain all of that and much more. If you'd like to join us, we're here, 844-305-7800. You can also tweet the program at Index Show. That's where you find me on Twitter. More when we come back. Go nowhere.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
All right, 844-305-7800 is the number. We're here. If you'd like to join us to talk about anything financial on your mind, a particular stock, mutual fund, ETF, or investment strategy. Coming up a little bit later, Sylvia Jablonski at Direction Investments will be with us. We'll be talking about relative weighted ETFs. Taking a look at some of the major asset classes, this is just kind of a big picture view. We do this on the show pretty much every week to help you have perspective on what's going on in global financial markets. This is your big picture view. If we take a look at the total U.S. stock market since the start of the year, SCHB, which tracks this group, that includes large as well as mid as well as small company stocks, ahead by 8.7%. Now, the month of January, of course, is over, and if you're wondering, you historians, January of 2019 was the best performance for stocks. The month of January, the best month in 32 years. Pretty impressive start. Of course, you knew at some point there had to be a bounce back after that horrific fourth quarter. So pretty good start thus far for U.S. stocks. Taking a look at international as well as emerging market stocks, also doing quite well. The leader really there is emerging markets, VWO, ahead by almost 9%. Developed market stocks also doing well, up by almost 7.5%. The area that has been lagging has been the bond market, total U.S. bond market, not even up 1%. BND tracks that area. Two final asset classes that are major and key and important part of all diversified and well-built portfolios. You've got global real estate, REET, ahead by almost 11%, and global real estate just soaring. Really the story there, and we talked about this last week with Dan Dolan at the Select Sector Spiders, the Fed sort of giving the market what it wants to hear, a pause in any hikes in interest rates, at least indicating that verbally. We'll see if they follow through, but that has been a real boon in the short run for some of these rate-sensitive industry sectors like real estate as well as utilities. So that area doing quite well. REET follows global real estate, again ahead by almost 11%. And then one final area which has been doing very well has been commodities. USCI ahead by just over 3%. So that's your big picture view. Look, see, and compare your own portfolio, your own performance versus these major asset classes. Those, by the way, are year-to-date figures. That means they are since the start of 2019 through the market close of February 1st. 844-305-7800 is the number. You can tweet the program at Index Show if you'd like to reach out. Now, we had a off-the-air, what was it? Was it an email or was it a tweet? I can't remember, but it was from Carl in Northern California. He had a question about the Select Sector Spider app, and I had a chance to talk with Carl off the air. He wanted to know how to get that app, how to find it, and it's very simple. First of all, you got to have a mobile device, and Carl, unfortunately, does not. He's in the process of getting it, but if you don't have a mobile device, the app is not going to be of any benefit to you, Carl. So once you get the mobile device, then you can go to the App Store. That's Apple's App Store, and you can download the Sector Spider app. It's free, and just search Sector Spider, SPDR, and you will find it. And I like it because it's got a real nice interface. It's easy to use, and it gives me all 11 ETFs and the sectors that they're tracking within the S&P 500 on one screen, which is really great. And it tells me whether those ETFs are up or down. You can use it when the market's open. Obviously, those numbers are going to be bouncing around all over the place, but it tells you what the actual holdings are within the fund. It tells you how many holdings there are. It tells you whether there's options available on the fund. all of these ETFs, the 11 sector spiders, do have options. Also tells you the expense ratio, when the dividends are paid, all the dividends are paid quarterly. And then it also shows you what the percentage or estimated weight of that sector is on the overall S&P 500. So for example, financials, ticker symbol XLF, the app right now shows me that financial sector represents about 13.5% of the overall S&P 500. So it's a very useful app, and you can, if you've got a mobile device, just download it. It's free, and I think you'll enjoy it, and it'll be quite useful to you as it is to me. Now, taking a look at my commandments for trading ETFs, we also have on the Twitter feed, by the way, at Index Show, and if I get time a little bit later, I will, express my views and just kind of tell you a little bit more about why I think it's important. But there was an article from Barron's that I linked to about why ETFs will save investors this particular tax season. And let me just say this, and I said this on the Twitter feed, that the ETF structure is and will always be superior to an index mutual fund. Amen, period, end of story. So these individuals, these anti-ETF crusaders who demonized ETFs, this is the one thing that few of them really discussed in detail. And the point is, in the taxable investment account, the ETF structure is superior in all ways. And so we'll talk about this if we get time a little bit later. If not, we'll table it for next week. But the point is, you need to understand this. If you own any index mutual funds, obviously any kind of active mutual funds in a taxable account, you need to pay attention to this, because taxes are a very big deal. We pay attention to expense ratios, we pay attention to bid-ask spreads, we pay attention to all these other frictional costs, and yet one of the biggest costs that we ignore is the ongoing impact of taxes. Even if we don't sell that asset, we still may be incurring taxes needlessly. And so this is why the ETF structure is and will always be superior, because it shelters, it insulates investors from that threat. Now let's get on to talking about the commandments for trading ETFs. The first commandment, and this may seem a little simple, but it's important, is to size your orders correctly. So the cost for trading ETFs in odd lot sizes is generally higher compared to round lot orders. Why is that? Well, most brokerage firms have a fixed minimum commission level. So odd lot orders are anything basically that's different than a standard round lot order of at least 100 shares. So investors who want to make a large purchase or sale that exceeds 10,000 shares or 200,000 in value should, obviously, if that's a big trade that you're doing, you want to always make sure that you're doing it in an even lot. But also, if it's a really big trade where you're doing 10,000 or more shares, or a trade that's more than 200,000 in value, you might want to consult a trading specialist so that they can help you to ensure that you get the best execution and the best price. So size your orders correctly. It's optimal and preferred that you do even lot orders of at least 100 shares. Another example, 200 shares, 300 shares. These are all even lot orders. An odd lot order would be something like 56 shares or 137 shares. These are not even lot share trades. So that's commandment number one. Size your orders correctly. I'm going to have a couple more commandments for you coming up a little bit later. Things to help you when you are buying and selling ETFs. Coming up next, Sylvia Jablonski with Direction Investments, relative weighted ETFs. Stay with us.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
First, the basic idea. Working people defer the money they earn. Next, that money can be used in the future to pay for basic living expenses, so long as it's wisely invested. To acquire these skills, tune in to the Index Investing Show with Ron DeLegge, a carefully designed program for working people who save and invest money. The Index Investing Show is now available at iTunes, Spotify, YouTube, and other world-class platforms.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
Well, the global stock market has staged a strong rebound here in 2019. Here to talk about that with us and more is Sylvia Jablonski. She's managing director at Direction Investments. They currently oversee $13.5 billion in a lineup of exchange-traded funds that go long as well as short. And Sylvia, it's great to have you back on the program.
Thanks so much for having me, Ron.
Let's begin with Direction being very busy with lots of enhancements to its ETF lineup. Let's start with the Portfolio Plus ETFs, which I think are a great choice for investors who are bullish on stocks but may not necessarily want to go all out with an ETF that has, let's say, 200 or 300% daily leverage. The Portfolio Plus ETFs offer an excellent, I think, alternative, and they recently adjusted the amount of leverage that they're using. Tell us more.
Yeah, sure. It's actually a great setup there. So, as you said, Ron, Direction's best known for the levered and inverse funds that are most relevant for magnified trades for short-term tactical traders. Those products are our core DNA, and they'll be around for years to come. But, historically, we've sort of been relevant for a very specific type and a small niche type of client, the tactical and shorter-term minded trader. But, our expertise really allows us to think outside of the box, and what we've tried to do is provide investors, whether they're short-term, intermediate-term, or long-term, with tools to more precisely, express their views. So with the Portfolio Plus, we're really the only provider that has these, and it's basically leverage for the long term. So we're catering specifically to strategic asset allocators, allowing investors to modestly boost their market exposure over longer periods of time. And, the thought there, or the thinking behind creating these products, was really that markets tend to rise over time. Of course, we have pullbacks. Of course, we have the financial crisis of '08 and these sort of notable periods of time. We acknowledge them. We see them, and they're certainly blips on the graph. But over time, the S&P 500 tends to outperform more than it underperforms. And we kind of thought, wouldn't it be great for a portfolio manager to have an option to sort of maybe compete with sort of the other guy and do something a little bit different and just enhance the basic building blocks or, the sort of secret sauce of his own model with just a 0.35 additional bit of leverage to the strategy he's running. So they're really leveraged for the long term.
Now let's talk about another exciting development, which is the introduction of 10 relative weight exchange-traded funds that are linked to the FTSE Russell and MSCI indexes. What is relative weighting, and who do these particular ETFs appeal to?
Well, so just about everyone has an opinion on the markets in terms of one sector, style, box size, region, or style essentially doing better than another. So, Ron, you might like small caps over large caps. I might like defensives over cyclicals or emerging over developed. And, if we have that view or a view, let's say, value will outperform growth, for example, historically, the only way that you could really express that view, particularly if you're not, a large asset manager with the ability to access stock loan and prime brokerage and things like that, is to just buy the side of the trade that you like. So, if I like emerging and you like developed, I go out and buy an emerging market ETF and maybe zero, developed, you buy 100% developed and zero emerging. And if let's say one moves 10%, the most that either one of us can make on that trade is 10%. But if you look at a relative weight ETF, what it does is it essentially takes a 150-50 structure. So it has a beta similar to the market, but we give you an increased exposure to the favored asset class with a short extension to the unfavored. So, very simply, if emerging outperforms developed, I want to win on the fact that I made the right call, but I actually am making two calls. I'm making the call that emerging will do well, will perform, and I'm making a call that there will be a spread and emerging will outperform developed. So what happens here is I get the performance of emerging plus the performance of the difference between emerging and developed multiplied by 50%. So, for example, emerging, let's say, goes up 10, developed goes down 5. I'm at 17.5 instead of sort of the maximum that I could have made on that trade, which is 100. So we're really looking to outperform relative to a long-only exposure. And, when your view is right, you're really doing quite well on the ability to get the performance of your pick plus the spread between, your pick and sort of the other side.
Yeah, and if you're just joining us, we're pleased to have with us Sylvia Jablonski, Managing Director at Direction Investments. Go to directioninvestments.com to learn more about strategic and thematic ETF investing. That's DIREXION investments.com. We talked earlier about the S&P 500, and as you know, Sylvia, it underwent a major change last year with the addition of a new industry group called the Communication Services Sector, and Direction now offers a bull and bear 3X ETF on this sector, TAWK for the bulls and MUTE for the bears. Why is this an exciting area for investors?
Sure. So we kind of have an ongoing joke here that the OG FANG gang split up. So, Facebook, Google, Amazon, Netflix, so all the big names basically, are kind of moved around to different places. So you've got Amazon in discretionary, you've got, Google and Apple are still sitting in tech, and then Netflix, Facebook, those are now in communication. So, why that's really interesting is that, traders have been really trading all of these names and have had exposure to these names, whether they're using, the S&P 500 or any tech ETF or, sort of the pre-GIC sector changes. But, talk is super interesting. I mean, recently you had some, fairly positive news out of Netflix, increased subscribers. And I think that a lot of these names, Facebook has just been absolutely beat up with the, regulatory stuff this year, privacy, security issues. All of tech, really, Google has been beat up, and Netflix kind of came out with some decent news. So I think that traders who thought that a lot of what happened in December was a good way to sort of reset and buy on potentially lower multiples and opportunity in the future, put on that talk and mute trade just basically to get access, 3x access because it's a 3x daily product to the exposures of Facebook and Google and Netflix.
Again, those two
and interestingly enough, actually, the other ones are. Oh, yeah. Sorry, I was going to say, and the discretionary and staples are like, want and need, or similar types of stories. Again, just everything is just sort of beat up, and we see some flows coming into there.
Again, those two ticker symbols, TAWK for the bulls and MUTE, MUTE for the bears. Now, when stocks are falling hard like they did in the final part of 2018, people don't have to make a sell all or sell nothing decision with their investments. One strategy is to keep the portfolio fully intact and simply add insurance protection with inverse ETFs. So let me ask you, what are the advantages of hedging a long or buy and hold only portfolio with some insurance using inverse ETFs?
Sure. So the inverse ETFs are, -1 in the performance of the index, just kind of what it sounds like. And the good thing about that is that, if you have a lot of portfolio managers that we talk to are heavily overweighted growth and cyclicals and, basically everything that's just been experiencing stellar performance in the last decade. But, they need to reduce exposure, and they don't necessarily want to sell that stuff and recognize gains. So an inverse fund is a really good way to, sort of protect the portfolio through, some of the downturns in the market without having the decay of a 3 beta fund. So there's actually been a huge tick up in inverse S&P 500 hedging. I'd just say in the last week or so, we've seen about $300 million moving around in the various products out there that are inverse hedges. And, going back to the relative weight, another interesting way to look at it is not necessarily just to take a view of one sector over another, but let's use that value growth example. Let's say I have too much value or too much growth and I don't want to sell it because I would recognize gains. If I go long value with the negative 50 short extension, I'm reducing my exposure to growth sort of organically with that trade too. So lots of ways to hedge.
Well, great ideas, Sylvia Jablonski. You just heard from her at Direction Investments. We appreciate you taking time to join the show. I'm Ron DeLegge. This is the Index Investing Show. More when we return. Go nowhere.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
All right, welcome back from the break. We just got off the line there with Sylvia Jablonski at Direction Investments, and we talked a lot about various strategies, one of them being the relative weight ETFs. I think this is something you're going to hear more and more about in the coming future. But the basic idea is you can overweight whatever specific investment theme that you want to emphasize in your portfolio. For example, if you want to overweight growth over value because you like growth and you think it's going to deliver better performance than value, you can play that strategy. You can play that by going for something like ticker symbol RWGV as in Victor, which is the Direction Russell 1000 Growth Over Value ETF. So you're going to capture the performance of growth, but then you're also going to get that premium or that excess performance over value. So it's a great way, again, to play that theme and be able to get your cake as well as the icing on top. One other strategy is emerging markets over developed markets. Now, so far this year, we have seen emerging markets incrementally outperform developed market stocks. Now, if this theme continues where we see emerging markets outperform and continue to lead, not only will you get that performance from emerging markets, but also whatever premium or spread that emerging markets outperform the rest of the globe, developed market stocks. So I'll give you a ticker symbol for that. That would be ticker symbol RWED, which is the Direction MSCI Emerging Over Developed Markets ETF. So there's a lot of different strategies. There's 10 of these Direction ETFs that play this particular strategy of relative weighting, and it's a strategy that I think you can add to your arsenal, and it's something too that we've got linked up to on our Twitter feed. You can read more about them. Just follow us at Index Show. 844-305-7800 is the number if you'd like to get in and talk with us about a particular strategy or something that you hear on the show, or even a question. We can talk about that. Let's get back to commandments for trading ETFs. I want to share with you a couple of other commandments. We talked about earlier sizing your orders correctly. Well, how about this? Using ETFs with tight bid-ask spreads. This is something we've discussed many times in the past. So remember, the ETF spread, when it comes to the price of the fund, is the difference between the bid price, what buyers are willing to pay, and the ask price, what sellers are willing to receive. So wider spreads add to your trading costs. So it's best to stick with ETFs that have tight bid-ask spreads. Before buying an ETF, check its bid-ask spread. See how it compares with other similar types of funds. Many ETF sponsors will provide regular updates on the bid-ask spread right at their website. You can also check Morningstar.com, which reports ETF bid-ask spreads in percentage terms, much like a expense ratio. And it's a neat way of presenting it because it helps you understand and get a better handle on the estimated trading costs for acquiring or selling a particular ETF. Now, the other commandment for trading ETFs is to stay away from the market close and open. So remember, when the market is opening or when it's closing, it's common to see wider bid-ask spreads for these ETFs because not all of the holdings within the ETF may be trading at the open. So think about that. If you've got something like let's say the Russell 1000, there's 1,000 holdings or stocks in that particular index, and the ETF tracking it, and you may not have all 1,000 securities at the open or close of the trading day. that those stocks may not be actively trading at those particular moments. And so that could create some discrepancies or wider bid-ask spreads in the ETF. And that, of course, is not good because it increases your trading cost. And so toward the market close, kind of a different thing happens. What happens is the authorized participants, also known as APs, they may be reluctant to take on large positions because they want to balance their books at the end of the day. They want to go home. And that can sometimes, again, lead to these larger than usual spreads on ETF bid asks. So as a general rule, when you're trading ETFs, keep a 30-minute window between ETF trades for the open and then 30 minutes before the close as a good rule of thumb. Stay away from that. So again, wait for the market at the very, very beginning when it's opening up. Allow at least a good 30 minutes for the market to open, and all those securities hopefully by then will be open for trading. And then at the same time, at the very end of the day, 30 minutes before the close, you want to have all of your ETF trades in before that. So that's another good rule of thumb. So these are commandments for trading ETFs that I think can be quite beneficial and help you. Now, one final commandment is to coordinate the timing of your trades. So there's differences in trading hours for an ETF's underlying securities that may lead to sometimes diminished liquidity in the fund, along with pricing discrepancies between the ETF share price and the value of its underlying holdings. So when you're trading ETFs that own, for example, international or emerging market stocks, one idea is to consider timing your order for when markets for those stocks are open. So for U.S. investors, you can do this with European and Latin American stocks. But for Asian and Australian securities, their trading hours have no overlap with U.S. trading hours. So that's an idea if you're trading or buying or selling ETFs that own international securities or stocks. That can even apply to bonds. So coordinate the timing of your trades. If you're buying and selling international or emerging market ETF, try to do that when those European and Latin American markets are open. So those are commandments for trading ETFs. Of course, there's many more commandments, and you can learn about them at my online courses. Go to indexshow.com, and this is part of the commandments and help that you get when you become a student. Now, we talked earlier about the superiority of the ETF vehicle over the index mutual fund and just mutual fund in general. I want to touch on that in a second, but I just want to give you a quick recap because I promised you that we would tell you what's going on with the key industry sectors within the S&P 500. Let's talk about the leaders. Ticker symbol XLC is the top performer. That particular ETF so far this year has gained just over 11%. So that's a top performer. And XLC, by the way, includes some of those names that are like Google as well as Netflix and Disney. That's all included in XLC. That's a top performer. Also, XLE, which is the energy sector, ahead by just over 13%. That is the number one performing S&P 500 industry sector so far this year. And take a look at some of those other ETFs that leverage energy. ERX aims for 300% daily exposure to energy stocks. ERX, a top performer, ahead by 42% so far since the start of the year. So that's been a good area. Now let's get back to real quick talking about the ETF structure and why it's superior to the mutual fund. This is an article that we'll expand upon on next week's program. We're going to talk about why ETFs are superior to mutual funds. And I want to share with you, and we'll talk about this more on next week's show just because time has run out on us, but the advantage that you have as an ETF investor in a taxable account. So stay tuned for that coming up on next week's program. In the meantime, you can get in touch with me, ron@indexshow.com. That's my email. And on Twitter, @indexshow. We'll be here again, same time, same station. Be sure to join us.
Thank you for listening to the Index Investing Show with Ron DeLegge. Connect with us on the web at indexshow.com. And be sure to subscribe to our podcast at iTunes, Spotify, or Google Play.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.